Hi guys, today I want to talk about free cash flows to equity. That's our topic for today. As we all know that we always face questions to do with free cash flows to equity, and usually they require us to calculate the free cash flows to equity. So before we talk much about how to calculate free cash flows to equity, let's first look at the kind of questions we can face when dealing with free cash flows to equity. So the following data pertains to a well-diversified company trading on the Zimbabwe Stock Exchange. This is the data. We have the reported information for 2017 and for 2018, and then given all those inputs, here comes the question. The company plans to increase the debt ratio to 50% by 2018. To reach this target, it plans to finance 45% of its capital expenditures and working capital between 2017 and 18 with debt. Calculate the current and projected free cash flows to equity. So in other words, you are required to calculate the free cash flows to equity for 2017 and for 2018. And then another question, the information below refers to Troitech Public Limited Company. And then you are given the information or the financial data for 2013 and 2014. And you are required to calculate the company's free cash flows to equity for 2013 and for 2014. So in other words, these are the kind of questions that we meet or that we encounter when dealing with free cash flows to equity. So the company plans to reduce its debt ratio from 44% to 27% by 2014. To achieve this, only the short-term debt, which is currently standing at 13,000, will be refinanced. All capex and increases in working capital needs will be financed primarily with equity, that is 9% and 10% debt. Long-term debt outstanding will be repaid with cash flows from equity. Calculate trade tax FCFE for 2013 and projections for 2014. And then part B, explain the relevance of FCFE to the sustainable operations of a firm. So these are the kind of questions, guys, we can meet or encounter in examinations requiring us to calculate the free cash flows to equity. So by definition, so equity investors receive a residual claim on the cash flows to the firm, which is they are entitled to any cash flow that is left over after meeting all the financial obligations of the firm, including debt repayments and the reinvestment needs of the firm. So in other words, we are saying equity investors, right, they are entitled to what's left after the firm has met all of its expenses, including the interest paid to the loan financiers or interest paid to the debt financiers or debt investors. So in other words, what is left, that is the overall leftovers, what we call retained earnings, is entitled to the equity investors. So in other words, we're saying free cash flows to equity are calculated based on those leftover amounts. So by definition, the free cash flows to equity are the cash flows that remain after operating expenses and principal repayments and any capital expenditure that are required to maintain the growth rate in projected cash flows. So in other words, after meeting every expense or expenditure of the business, what is left is what we call free cash flows to equity, and that is entitled to the equity holders of the company. So free cash flows to equity for a levered firm that is operating at its desired level of gearing, right? So by the desired level of gearing, we are saying the company presets what it calls the desired level of gearing. That is the amount of debt finance that a firm expects to operate at. So for a firm like that, it has its own way of calculating the free cash flows to equity. So the first thing or the first step is to determine its debt ratio. By the debt ratio, we are saying the ratio of debt in the total equity of a company. So this is the formula. Debt ratio is equal to debt over debt plus equity. In other words, it's debt over total capital of the business. And then here is the pro forma of how you can calculate the free cash flows to equity. So you go and subtract the capex minus depreciation multiplied by the debt bracket, which is 1 minus debt capital of the company. So in other words, you are excluding the debt component in the capital structure of the business, and you subtract that from the net income. And then as well, you subtract the changes in working capital adjusted of the debt component as well. In other words, we are saying our capex or our capital expenditure is at some point financed by debt capital, and then our working capital is at some point financed by the debt capital. So by 1 minus D bracket, we are adjusting these two aspects of the debt component so that you can be left with what was financed by the equity capital of the business. So free cash flows to equity for a levered firm with a debt ratio below the optimal level. And then the formula for determining the debt ratio is just the same. What is different now is that this firm now requires additional capital in terms of debt capital or any other sources of capital. So proceeds from new debt issues is what we want to determine as our first step. So we first calculate the debt ratio, and then the second step is to determine the proceeds from new debt issues, which is equals to principal repayments plus the debt component, which is the debt ratio, multiplied by the capex or capital expenditure plus changes in working capital. That's how we find proceeds from new debt issues. And then this is the pro forma of how you can calculate the free cash flows to equity. So for 2017, or in other words, this is the example of years that we want to calculate for 2017 and 2018. So net income is our first entry, and then we add back depreciation. Since it's a non-cash item, we need to add it back to our net income. So note this, guys, that whenever you are dealing with free cash flows to equity, you don't adjust for non-cash items. So if they are adjusted for in your income figure, you need to add them back to that income figure. And then going on, we subtract the capital expenditures, we subtract the changes in working capital depending on whether they are increasing or they are decreasing. Note that, guys, an increase in changes in working capital, an increase in working capital is deducted from the net income because it represents cash outflow in incurring expenses or in maybe acquiring stocks. This reflects a cash outflow, guys. And whenever there's a decrease in working capital, that means that's income to the business. In other words, giving an example maybe of debtors, if our debtor decreases, it means more debtors are paying their dues to the company, hence there is cash inflow to the company. And then we go on to adjust for principal repayments. We adjust them. Why? Because we are repaying back the debt capital we acquired. And then we add process from new debt issues. Remember, the process from new debt issues is what we calculated is in the previous slide using that formula that we explained before. And then here is how you can calculate the free cash flows to equity for a firm that is operating at a debt ratio above its optimal level. So the debt ratio formula is just the same, and then process from new debt issues formula. The difference now is before, the formula consisted of the principal repayments plus the debt component multiplied by the capital expenditure plus changes in working capital. But in this case, guys, the formula is now new debt issues plus debt component multiplied by capital expenditure plus changes in working capital. Remember that D represents the debt component in our capital structures. And then this is how you determine process from new debt issues. And then this is how you calculate your free cash flows to equity for a firm that's operating above its optimal level. Remember, we add back non-cash items, and then we adjust it for capital expenditures, we adjust for changes in working capital, and then we adjust it for principal repayments, and then we add the process from new debt issues. So the difference is only on the process from new debt issues with the different formulas explained in the previous slides. So remember to subscribe and to like and to comment if you like this video. And then our next lecture will be solving the questions that we explained or we showed before at the beginning of this lecture. Goodbye, guys. Thank you so much.